This video is brought to you by Answerly, a question platform that pays you for adding high-quality answers on different questions. The users are rewarded in Answerly tokens, which they can easily convert into dollars or any other cryptocurrency by using one of the exchanges mentioned in the description.
Manipulation of markets has gone on since trading began. Unfortunately for those wanting to profit from manipulating stocks and traditional assets, doing so is highly illegal and tends to result in high fines and jail time. Hello and welcome to our YouTube channel. In today's video, we'll be talking about the crypto market being manipulated. In crypto, there have been a lot of gray areas and the markets were volatile enough for individuals to manipulate to part hundreds of thousands of people, if not more, from their money in a whole series of promotions designed to pump and dump project after project. However, greed, money, and success can be big motivators, and there are always some who will keep pushing the gray areas of the law until they either get their way or get caught. Before we dive in, like this video, smash that subscribe button, and click that notification bell right now if you don't want you'll be manipulated by someone that you don't like in your entire life. You don't want that to happen, right? So keep on watching. Going back, cryptocurrencies like Bitcoin are based on systems that are supposed to be inherently protected from fraud. Yet the U.S. Department of Justice has opened a criminal investigation into manipulation of Bitcoin prices. How is that sort of activity even possible? Accusations that the cryptocurrency market is being manipulated have long been thrown around. Market manipulation isn't just an issue with the cryptocurrency market, though. Traditional finance also suffers from market manipulation, but due to the liquidity of this market, it is more difficult and usually harder to spot. On top of this, the traditional financial markets are much more heavily regulated than what we see in the cryptocurrency market. While market manipulation has slowed in recent years in the cryptocurrency industry, when compared to the wild early days, there is still clear evidence that it is apparent. Meanwhile, Bitcoin and other cryptos have slumped after record highs. Is market manipulation the reason why? Bitcoin and other cryptocurrencies have fallen sharply after seeing record highs just last week. Bitcoin's price plunged to $58,400 and hovered just under the $60,000 threshold as the crypto market is again becoming a sea of red. It marks a 12% drop from the record high of $69,000 set on November 10. The second largest crypto, Ether, meanwhile plunged more than 14% since its record last week to reach $4,244. The reasons why cryptos have been so volatile of late is unclear, but there are a number of factors at play. One reason may be due to market manipulation, argues David Gerard, the author of the book Attack of the 50-Foot Blockchain, and it is all due with Tether, a blockchain-based cryptocurrency whose tokens are backed by an equivalent amount of US dollars. Tethers are supposed to be all backed by dollars, and there's a lot of reasons like settlements with the authorities that suggest this has not been the case in the past, and we shouldn't presume it's the case now. Gerard told Euronews next. So it looks like 3 billion Tethers backed by nothing were used to pump the Bitcoin price up at this particular time. When they stopped, the Bitcoin price dropped, and that's basically the story of the shenanigans that went on in the last week or two. Gerard argues this kind of market manipulation and fake liquidity happens all the time. The other reason for the crypto price slide is the continued fallout from China's crackdown on Bitcoin mining, which led to an exodus of miners to the US and Canada. Gerard points out it is not just because of mining regulation that crypto prices have slumped. He argues those exiled miners have $1 billion of bitcoins that they are keeping as stockpiles and not selling them. A pump and dump scam typically involves inside groups of manipulators taking positions in an altcoin or digital token prior to a pump signal to buy the asset in a coordinated manner for social media users. The dump involves a pre-planned crash colloquially known as a rugging or a rug pull. The 2020 study suggests about 15% of all cryptocurrencies traded on exchanges like Binance and Yobit were targeted at least once over a 7-month period, with 2 pumps across altcoin markets per day on average. The average cryptocurrency pump and dump produced a 65% price rise in the space of minutes, with an average of 8 minutes for a coin to reach its peak price on volume, around 13.5 times the usual daily volume according to the research. An average manipulators buy around $24.3 million or $33.3 million worth of coins prior to a pump signal. This results in a conservatively estimated profit figure of $6 million per pump by reconciling the differences in volume weighted average prices before and after a pump signal, according to the research. Well, market manipulation is the deliberate attempt to artificially influence or interfere with asset prices. Typically, scammers manipulate markets to tip the scales in their favor and make quick returns. Since cryptocurrency markets are still relatively new and less regulated, they're more vulnerable to market manipulation. However, there are ways crypto traders can avoid falling victim to these scams. For starters, it's best to trade on larger, reputable exchanges that have established security policies and internal controls. Additionally, investors can safeguard against unlawful tactics in the crypto markets by thoroughly researching coins, brokers, and exchanges before making any financial decisions. For instance, legitimate cryptos and companies typically offer potential investors an abundance of learning materials on their websites. Crypto markets have unique characteristics relative to other asset markets, but investors are still susceptible to traditional scams like account hacks and identity theft. To trade crypto, investors need a crypto wallet, which can be a digital or physical device. These wallets have keys, both public and private. The former is a public address that allows crypto to be deposited into the wallet. Similar to how routing and bank account numbers enable direct deposits, the latter is like the password to an online banking platform. Whoever has access to that password can control the funds within the account. Just as you wouldn't share your credit card number with a stranger, keep your private keys somewhere safe. Fraudsters can use this information to hack accounts and withdraw funds, and they'll employ various tricks to get investors to reveal their private information. Be cautious of crypto phishing emails that may pose as a crypto exchange or wallet provider. The same goes for out-of-the-blue and unsolicited promotions from suspicious websites and imposter accounts. Scammers often pretend to be celebrities or affiliates of major companies, promising guaranteed and immediate returns if you act quickly. So how investors can protect their crypto? Even the most advanced and enthusiastic cryptocurrency experts understand there are many new and evolving risks in the world of crypto right now. Some have weathered scams themselves, such as the blockchain investor and entrepreneur Ian Bellina, who said he lost $2.5 million after his private wallet key information was compromised by someone hacking into his Evernote account. Bellina's story highlights the possibility of loss and fraud when dealing with such a new, volatile asset class even for successful investors. Financial experts advise most passive investors to keep crypto holdings to under 5% of their portfolios and never to invest in crypto at the expense of saving for emergencies or paying off high-interest debt. If you look at the price chart for many cryptocurrencies, there's often a very sharp sudden spike in their earlier days. Most cryptocurrencies charts either have a more or less gradual decline or increase in price, or display a virtually straight horizontal line indicating not so much a lack of volatility as a lack of trading or interest altogether in the project. You can also sometimes see big waves where the cryptocurrency was gradually manipulated and affected by markets. But in many cryptocurrencies, particularly the smaller, lesser-known ones, at one or more times in their history, there is a sudden vertical needle in the charts. An almost instantaneous increase in its price by hundreds of percent, and then shortly, or often even almost instantly after just as rapid a decline in its price back to where it started. Stock exchanges that don't take adequate measures to prevent stock manipulations can face heavy legal penalties, so for the most part they play above the law. Unlike traditional stocks where markets are heavily monitored and regulated, cryptocurrency, as we've already seen, has been a bit of a Wild West. Regulation is starting to come, but until then, crypto markets have been treated as a free-for-all adventure ground where anything goes. A little manipulation of crypto prices may lead to a boom in the crypto market, while significant manipulation can cause a price surge. With or without price manipulation, cryptocurrency remains one of the most popular forms of investment, allowing investors to efficiently and quickly transfer funds while enjoying investment security. Do you think the prices of cryptocurrencies are being manipulated? Let us know your thoughts about this video in the comments section below.
If you like this video, make sure to smash the like button and subscribe to this channel. To learn more about Answerly and Answerly tokens, check out the links in the description.